Hello, guys. Welcome to the second episode of um, Simulcast. Today, we are going to attempt to answer some of the questions that we've gotten since our first episode, mostly related to how to tell when an option is expensive versus an option contract that is relatively cheap, just based on what I mentioned in the first episode. I would quickly caveat to say again that this is solely for entertainment purposes, as we always do for in our disclaimer. We are not professional traders at the Spy Scalpers. We just do this for fun, and we hope to make sure that you're highly entertained. This, whatever we say here, is not a recommendation for trading. You do all your trading at your sole discretion, and you're taking all your risk based on your own risk management strategy that we really advise that you adopt. This is solely for entertainment purposes, and we are not in any ways advising you on how to trade. We are going to attempt to show what we do if we are placing trades on ourselves by ourselves that we think for option contracts that are expensive or not. I did mention in now that we have that out of the way, in our last broadcast that one of the things that we use to gauge an expensive option contract is the IV percentile or the IV ranking. I'm going to share my screen now and run through quickly what I mean by that. When you are looking at our dashboard, this is an example of what you see in the big movers scanner. Of course, you have the quotes, which is simply the tickers that are meeting our current customized criteria. Then the next column just after the tickers, the closed previous close for the respective tickers. BA, for example, closed as a last trading hour, live trading hour, not extended hour, to the 6.68. Then opened the next day. This is frozen as a last trading day. I think it was Friday, the 2nd of July. Opened that same day for 239.58, closed on Thursday to the 6.68. Currently, as at the time we were viewing it, the market price or last price was to the 6.68. Then this is the column I really want to dwell on today, and I'm going to come back to it. It's something very, very important that I should pay attention to before you use our scanner to trade. It is the IV percentile, which is simply the percentile of the implied volatility currently relative to the historical, relative to the implied volatility for the period. As at the time of trading, BA was 1.78, so in the 25th percentile. The next column is the volume, of course, being traded for the equity. Then the next column is the net change from open, not the normal net change that you see in Thinkorswim. We had to also write this to show net change currently from open. Then the next column is the average true range for the relative, the equities. Then what we have here is another very important one, is the market maker move. Well, that is the price the market maker is thinking that the option is going to move for a particular period, which is the week of closing. I've explained the other parts to you earlier. So let's go back to the IV percentile. I mentioned in our first episode that I usually don't recommend buying options. Buying is the word in emphasis right now, not selling. Options that are in their 50th or 75th percentile upwards. So essentially, if this column is very close to 50 or above 50, I tend to now buy a direct call or a direct put, because that to me shows that volatility is significantly priced into that option, and that option is going to be expensive per se, to use that term loosely. So one would argue, then what do you do in that case? Do you just not trade it? I would say, no, really, not necessarily. You could still trade it. You could go ahead and disregard what I have just said and buy direct call or puts. It's your trade strategy. Or you could try and hedge your trade using a margin account and trading a buy-legged, multi-legged option trade, or you could be an option seller. In that sense, you are selling volatility. So let's look at NTLA, although I don't have anyone that is 50 or more here, but I'm going to use NTLA as an example. So NTLA right now, Intel Pharmaceuticals have been moving very well this week. It is showing that the IV percentile currently is 49.19, really close to 50. So I will be very conscious in trying to do any direct trade, one-legged trade on NTLA. What does that mean? I would just ignore NTLA when every other indicator in our scanner is probably showing that there is a trade for NTLA. Either you are going to be shorting NTLA in the 5-minute to the 30-minute time frame, probably the whole intraday time frame, or long in NTLA in the swing time frame, because the ADX, the stack MA is really green, like we have captured in episode 1. So what do you do in that regard? That is where you have to now try and see what other trade is available for NTLA. What will I do? Instead of going and buying the NTLA option, I'll quickly show you what I mean by NTLA being expensive. If we go to the next option chain for NTLA right now, which is the 16th July 2021, though as at this moment, you can see just one contract at the money for NTLA call is $12.30. And one put contract for NTLA at the money is $10.40. If I compare these to the strike price of 160 and the current stock price of 3.71, that simply means that this is almost like $7 more expensive. So that is simply straightforward. When the market maker is saying that this has an $11.37 move, there's already a $7 volatility priced in, so you probably only have about $4 move to make. And this is actually at market close that I am making this video. By the time market open, this is probably going to be trading around $14, and this is probably going to be trading around $15. So this is an expensive option contract. So what do you do in that regard? That is where spreads come in to help. And how do you trade a spread? I'm going to cover two types of simple spread to trade. I'll start with my favorite, which is the book put spread. The book put spread is a credit spread where essentially you are an option seller, and you are trying to actually sell volatility and capture premium, which is a good way to hedge risky and expensive trade, and also minimize your loss in case it goes against you. So let's start with trying to sell a book put spread, and I would So what I will do quickly is, this is the SPY chart on our standard deviation channel. I'm going to put NTLA here, and this is the NTLA chart in essence. Right now, we are saying, okay, we want to do a book put spread for NTLA. I have put NTLA within the Kettner channel, starting with the main in the middle, and one average true range as the first boundary, and two average true range in the second boundary, and three average true range in the third boundary. You already know what average true range is. I might run another video or an episode if people are interested to cover what it is. So what I will do is, since NTLA, assuming NTLA is bullish and it's been bullish for the week, so I am going to sell a put, saying my assumption would be that NTLA will not fall below its 2 average true range, or so I'm essentially bullish, but I will be selling a put based on the average true range. So I look at the average true range of NTLA right now. So it's 163.4. This is an example. The best case is actually to sell on minus 1 ATR. But since NTLA has already fallen below minus 1 ATR right now, I'll use the minus 2 ATR, which is currently showing 163.41. So I'm going to place a trade of 163.41 with the assumption that NTLA is not going to fall below 163.41. That's essentially the trade. So I will come here. I would like to always target 10 to 15 days ahead. So this meets the criteria of 10 to 15 days ahead, which is 11 days. So we'll come here. 163.41 was the value, right, of 2 standard deviation. 163.41 actually, yeah. So there's no 163.41. So the closest to 163.41 in 116 and 165, but we are looking for it not to fall below. So we are going to take 160 instead. So I'm going to sell a put, sell vertical, a put. So it gives me this already customized trade. So, and it is for 2.51. By the way, if I have not mentioned this before, you cannot do spreads without a margin account. So if you don't have a margin account and you don't understand what a margin account is, I think it is time for you to do that and understand that. Can cover what a margin account is in another episode, but you could actually read up on that on the internet. So, but you do need a margin account to be able to do spreads, period. You cannot do this on a cash account if those of you are trading on a cash account. So this is a $5 with 116, 155 put spread credit. So I'm actually supposed to be selling. So I bought in that case, sell vertical. Yeah, this is the one I should be doing. The other one was buying. So you are selling a book put spread, which is a credit spread for a credit, in this case of $2.5. And that's really it. So, but how do you know this is a good trade? I will come here and try to analyze this trade. So what this is saying is the upward up to closing for a one book spread sale is about $250 credit, with the potential to lose about 250. So that's a 1-to-1 ratio, right? But if you actually set it up right and it meets your criteria, there is almost a 70% chance, 75% chance that you are going to be in the money as soon as you go into this trade or before expiration, because this is 164.31 that we are seeing as the current price. So NTLA needs to fall below this current price for you to start losing money, and you start losing like $12, $14, and your max until you get to your maximum loss of about minus 250 at expiration, which is the 17th of July, or $72 for that spread as it progresses. So most times when I say bull put spread and you are able to do it right on the chart, you are going to always be in the money 75% of the time. So you start making your maximum money 250 at about when NTLA get to 180.74. So this is your probability or your risk chart simulated. So when I always look at this simulated chart before I place the trade, I'm looking for trades that are 1-to-1 or 2-to-1 risk strategy for me to play. I like book spread, because even if the stock trades sideways, you will likely go. That is why it's one of my favorite credit spread, or spreads to do, compared to the second one I'm going to show right now. So in essence, you confirm this trade, and you confirm and send the trade, and you are out of the trade. Essentially, you place the trade as it is right now, or you decide to increase the quantity. It doesn't change the risk profile, it just changes the amount you are putting in and the amount you are going to get at. So if we decide to do 10 in this case, as you can see, it's a 2,500 possible gain at expiration versus a 2,500 loss. So you don't lose more than you put, even at expiration. And if you sell before expiration, if it goes against you before expiration, you actually lose about 1/3 of what you put in, compared to just being in the trade directionally and selling a put, a naked put that can really wipe out your account. You don't want to be selling a naked put, essentially. So that is how to trade. One way to trade expensive contract by selling bull put spread. Another way that can be done, and somebody might ask quickly, and then quickly cover this, that what about closing? As soon as exiting the trade, I never really wait till expiration to close a bull put spread. What I do is immediately I go in, I set an exit for 80% of the contract. So you already sold, you buy it back for 0.2 of what you sold it for. So if we sold this for 2.5, I am going to say my exit as soon as I go into this trade is 2.5 times 0.2, assuming that is what. So I set a buyback of 0.5, and it fills easily for bull put spread. Another thing to do for a bullish trade is not bull put spread, but a call spread, a call debit spread. A call debit spread is the same strategy. You are being bullish, but you are trying to change your assumption. So let's look at NTLA within the channel right now. So you remember for bull put spread, which is a credit spread, we said NTLA will not fall. That is the keyword, will not fall below 163.41. Then what we do for the reverse trade, not necessarily the reverse trade, but just a debit spread, we are saying that NTLA will get to, we keep going and go beyond. The credit spread says will not fall. Debit spread says will go beyond. So we are going to say, oh, in this case, let's say 1 ATRO is 166.66. So our debit spread is going to look for 166.66 is not there. So let's look for 165. We are going to, at this point, buy. You remember in credit spread, we sold. but this time we are a buyer of the vertical. So we are buying 165, 170. The interesting thing is when you look at the risk chart, analyze trade for the debit spread, it is always almost better, every time better than the book put spread. But interestingly, it fails more than a book put spread. That's one thing I have found. Chances of book put spread being positive, being a positive trade is more than a debit spread being a positive trade, even if the chart does not tell you that. Like look at this chart, for example. This chart is saying that this is a 210 versus a 290, which is actually almost like a 1.5 and 1 risk ratio. But essentially, looking at this, we are saying that we stand a chance of getting 210 if we commit 290. That's what this chart is saying. And sometimes you will look at it, it will say, oh, you stand a chance of getting 500 if you put in 100. It looks like, oh, the debit spread is always a great analysis when you look at the risk profile. Well, I found out that it's not the case. The one that doesn't really look that way, which is the credit spread, is almost always better, because when the market trades sideways, you can be good. So coming back to the debit spread, this is saying NTLA needs to fall below 164.31 for you to start losing money. As it is right now, if NTLA just progresses a step further, you can see in your pin chart, you are making money and you now make your maximum gain for one contract of debit spread for up to 210. If you up it up to like 10 contract, like we did for the book put spread, you can see you stand a chance of making 2100 and you're putting in 2900. Not the best trade that I would do. So you can see in the end, the credit spread looked better. Then you confirm and you close this trade, and you execute this trade and you get filled. If you get filled at the middle, if you don't, you just wait for it. Never chase a trade. So, but then coming back to closing, how do you exit this trade? It is different from what we did for a credit spread. Credit spread, we bought it back at 80%, that's 0.2 of the amount we paid. But for debit spread, my closing strategy is to actually sell it at 70% of the width. It's different right now. So in this width is 165, 170, the width is 5, 170 minus 165. And so I am going to immediately place an exit trade to say 5 times 0.7 and check it is 3.5. So I am going to buy it at 2.9 and sell it back at 3.5. That is how you close a debit spread. So that's really it, and I will recap what I have attempted to cover. I say you look at always before you go into a trade using our scanner, try and check what the IV percentile is saying. If the IV percentile is equal to 50 or greater, we will not recommend that you do a direct call or put, but again, I'm saying not recommend. You own your trade. You can do as you wish. Again, disclaimer is out there. You are doing this as your sole discretion, but we will not do that. So when we start seeing trades like this, scans pulled like this, we think of how to hedge our trade using a spread. Mostly we do it either by selling a put, which is a book put spread, a credit spread, or buying a call debit spread. And we close our book put spread at 80% of, buy back at 80% of what we sold it for, which is 0.2 times what we paid. For the debit spread, we close it at 70% of the width. Please keep the questions coming, share as best as you can, and do not forget to keep subscribing and telling your friends to subscribe to our channel. We've had very great testimonials of people using our trades strategy this week and eating up to a minimum of 30% of their entry, especially for the indexes, which is what you see here, and also for our SPY scalping strategy, as well as our big movers. Thank you very much and have a good day.